I guess we're still in a time right now where it's fluctuating a little bit in how companies are thinking about, do I want to bring my employees back full time? Do I need to bring them back 3 days a week, 4 days a week, whatever that is? And that's going to determine how a lot of this plays out, right?
Right. Although I think there's increasingly widespread agreement that unless you're in a person-to-person services business, a restaurant worker and the like, 5 days a week is not going to be the norm. It's not the norm at Wharton. It's not the norm in most office-using firms.
Welcome to The Ripple Effect, the podcast that takes you on a journey through the minds of Wharton faculty. I'm your host, Dan Loney, and in each episode, we'll be diving deep into the inspiration behind the groundbreaking research that Wharton professors have conducted and exploring how their findings resonate with the world today.
Well, obviously, when you talk about real estate, there is a lot of conversation about new and existing homes. There's another side to real estate that you also have to look at as well, especially in the wake of the pandemic and now things like work from home, and that's commercial real estate. And pleasure to be joined here in studio by Gyourko, who's a professor of real estate here at the Wharton School. Good to have you in here. Thanks very much.
Thank you for having me.
This has been obviously such a unique time for real estate in general, but when you think about commercial, how do you put into perspective what we've seen play out over the last several years because of the pandemic and work from home and inflation rates and how companies are thinking about what their footprint is going to be in the future?
Well, the big shock is work from home. And by commercial, you mean office, because there are many, many sectors of commercial real estate. Data centers are doing extremely well with developments in AI. But office has been hit by what I think of as an obsolescence shock, akin to what Amazon and the web did to malls 15 to 20 years ago. It is a very deep and big shock, and it is roiling that sector of real estate.
And so part of the concern is obviously the vacancy rates that a lot of these office buildings are dealing with. And I guess we're still in a time right now where it's fluctuating a little bit in how companies are thinking about, do I want to bring my employees back full time? Do I need to bring them back 3 days a week, 4 days a week, whatever that is? And that's going to determine how a lot of this plays out, right?
Right. Although I think there's increasingly widespread agreement that unless you're in a person-to-person services business, a restaurant worker and the like, 5 days a week is not going to be the norm. It's not the norm at Wharton. It's not the norm in most office-using firms. So I think there's agreement it will be 1 to 2 days on average with a huge amount of variation across that. And Dan, that's somewhere between a 20 and 40% drop in demand for offices. That's why the vacancy rates are above the levels we saw in the worst of times in the GFC.
So how will companies then adjust to that? Because I think when we talk about, companies taking 2 floors in an office building or whatever it is, and you have that 5-year lease, 10-year lease, whatever that number is, it feels like the companies want to try and keep that as a presence. They obviously have to kind of readjust that thinking because presence is one thing, but bottom line is another thing.
Right. I don't know of many companies at all who are increasing their footprint in office. It is not true that everyone's going to work virtually. It won't work. One of the ways is, again, at Wharton, we teach in person. It's clearly superior. If we teach in person, that means I need to come in and work on campus. But for many offices, that's not true. And I think we're seeing a permanent decline in demand. It's an obsolescence shock. And it's led to a bifurcation in the office sector. The newer, better buildings are filling up with tenants taking less space than they would have 5 to 10 years ago, but they're filling up and they have good rents. But then we have this other sector, Class B, it's called, in office, where typical vacancy rates 15 to 20%, with a big dispersion about that, which means there is a decent amount of product out there with 30 plus vacancy rates, and you will lose money. That building will fail unless those conditions change.
So for some of those properties then, I guess, are they ones that kind of fall into this theory that's out there about the refurbishment of some of these office buildings into potentially other types of uses, and
apartments
being one. But there, it seems like there is so much potential of that type of space out there that how could we even, do we need to even serve that level of apartment use?
It's too expensive to convert. It will happen. It will happen in markets where apartment rents are really high. There's a really wonderful paper by a group of economists at Columbia who have looked into this. And in New York, where, believe it or not, monthly rents can reach as high as $8 a month, a foot a month.
Yeah.
In parts of Manhattan, you will see conversions of offices because those authors estimate $500 to $600 a foot in conversion costs. In Philadelphia, I know a firm who's working on one building downtown. It's about $300 a foot conversion costs.
Right.
That means in Philly, that will happen no more than 5 times throughout this cycle.
Right.
The conversion costs are just too high given our level of rents. So conversions are not going to solve this problem. They will happen, but they won't solve the problem.
What then is the expectation for new build? And are we talking about rates that maybe are similar to what we saw before the pandemic, or is it at lower levels? And I'll throw this into the mix. Obviously, we have seen new office buildings going up with more environmental friendly components that are in the mix as well.
That's for sure. Those are expensive. It's expensive to be environmentally friendly, but that's what, if you're going to have a footprint in office, you want that for your employees. It helps you get your employees back. So that's going to happen, and those rents will be high enough for those folks to make money. It's the other buildings which are going to fail, and they're a real threat to urban centers and to the public fiscs of governments like Philadelphia.
Are we seeing, or will we see, real estate investors really struggle and potentially really have to fight at their bottom lines as we move forward because of some of these issues?
Oh, in office, you're already seeing it. You are seeing office trades in some markets at anywhere from 25 to 50% of purchase price pre-pandemic. So you're seeing deep, deep discounts already. That means a bank is basically working with the owner. The owner's going to give back the keys, and the bank's facilitating a sale to get as much of its loan balance back as it can. That's how problematic it is for buildings that simply cannot convert.
One of the other things I wanted to ask you about then is as well how this shift in and around commercial real estate is going to be impacting the cities and the governments and their tax footprint, because when we see it here in Philadelphia,
we sure do,
about how much the city is giving back to employees who have a contract to work outside the city with their company, and they're paying wage tax, but they're going to get it back. There are a lot of components that city governments are really having to rethink right now.
I don't think any city government understands the magnitude of the problem. Because of long leases, 5 to 10 year leases in office, this is like a slow motion train wreck in a bit. The buildings won't fail. Some are failing now, some will fail next year, but over the next 5 years. And the problem for the cities is not just that the office won't pay property taxes anymore. Around office nodes, business ecosystems built up. Bars, restaurants, sometimes hotels, small shops.
Yep.
They will not be profitable. They were built and created. Their business models were flows 5 days a week of people in the offices. You're going to see it's a threat to whole neighborhoods, and it's mini neighborhoods in every large city. It's unavoidable. I think this is a true permanent obsolescence shock. It will not kill all the office market, but it will kill a meaningfully large number of buildings that will negatively impact public finance in cities.
So how does the real estate owner then go about trying to mitigate that part of the problem? Because if you have small businesses that...
I don't think they can.
Right.
I don't think they can. Ultimately, this is, invite me back in a few years. Ultimately, I think the federal and state governments will have to support workouts to prevent these neighborhoods with office buildings that won't make it through this. Otherwise, you're going to see real problems in cities, real fiscal problems in
What's your
cities.
expectation on rent prices just in general of where they are probably going to have to go with all of these dynamics at play? Because I think for me, I think the thought process is some of these landlords are going to have to cut back a little bit in order to not have mass exodus from companies or even some of these small businesses.
For sure, although it's remarkable, rent growth is still pretty strong in the best buildings. They're the ones filling up.
Yeah.
Those are the environmentally friendly buildings. They have outdoor space. They're configured right. It just takes big capital costs to get that building created. I think you're going to see more of a bifurcation where a number of buildings actually fail. They literally disappear. Some will get converted into apartments, but most will be torn down and replaced by something else over the next decade. It's going to be a long story and struggle for cities in this regard.
I guess what's interesting about it is this: if you think about before the pandemic, when you look at something like malls, we were seeing a little bit of an exodus to begin with.
Oh, you saw more than a little before the pandemic.
But nobody, I think, could forecast seeing something like this develop the way that it has.
The pandemic was uniquely bad for lower quality office product. And again, I view it as a true obsolescence shock. Just like Amazon and its competitors made a decent amount of mall space obsolete, the pandemic forced all businesses to work from home for a while. And then they realized, wow, at least for a short period of time, we could actually run a business. Yeah. I don't know a business in any sector who doesn't think their finance and accounting ran just fine. Work from home. So why do you need those folks in the office? That's what's shrinking the footprint. You talk to law firm, managing partners, and they'll go, there's certain days we need to be here, but it's not 5. So they just shrink somebody's got to be a big loser, and it's going to be the lower quality B offices, which are going to be the big losers.
And all the while still having the component of, companies looking for the best deal within cities, on their rents, on their tax rate, on all of those components. So there's a lot of, I would say, double whammy, but it feels like there's like 3 or 4 whammies going on here right now.
I mean, it's all driven by the decline in demand. I think it's a permanent decline in demand that over a very long period of time, the economy will grow and will grow out of it. Yeah. But that's a decade or two. In the short run, it's sobering. There'll be a number of landlords who just give back the keys. And there will be cities facing this fiscal threat of once they get back the keys, they no longer pay property taxes, and the businesses around them start to fail too.
So there is potentially a path to kind of alleviate some of this, but it's still a ways off at this point.
Yeah, I don't think anybody, but a few academics are starting to think about it. It will take real resources. I can't imagine cities like Philadelphia dealing with this on their own.
Yeah.
It will take state and federal resources.
All right. Joe, great to have you here today. Thanks very much.
Well, thanks. I appreciate it.
You got it. Joe Gyourko, who's a professor of real estate here at the Wharton School.
Thank you for listening to The Ripple Effect. We hope you found this episode informative and engaging. Don't forget to subscribe and leave us a review so that we can continue to bring you the best insight from the Wharton School.